Are you ready for a market crash? Well, there are signs in the market that are suggesting this, but don't for 1 second think that is actually our opinion. If you've been following us for a long time, you know we do not make this sort of market predictions. Instead, what we help you guys understand is how to prepare for a market correction. That is far more important because you can predict, but when and if the market crash arrives, what are you going to do? Many people don't know, right? Because there's a lot of panicking and emotion flying around. Too busy to find stock ideas? Check out Fire Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description. So anyways, you have here two signs that the market is, to prove that the market is at an all-time high. The first is the S&P 500. It almost doubled in 5 years. I'm guessing there's a 13% to 14% growth rate every year. And of course, Bitcoin went up 9 times in that same period. Of course, not without a lot of pain, especially in 2023. But you can see, right, 90K all-time high.
Yeah.
So risk on. Now, the question is, what if a crash is coming? And then maybe I can share some stats which we shared, I think, a couple of weeks ago, which is the S&P 500 has been only cheaper 5% of the time in the past in their history. Well, anyways, what does that mean? It means that they are more expensive 95% of the time at this current juncture. So, but the Malaysia one is a bit flat, but you can say relatively we are in a some semi uptrend, right? Especially when you take the 1 year change.
Yeah. Exactly. And you can see that there's multiple times that we experience a correction. Correction, our definition is here, means they corrected 10%. So you can see that in 2016, there's one time, 2018, 2020 is got COVID-19 crash. I think 2018 is something to do with Trump's policy also because he did more of a tariff at that point of time. And then 2021 and 2022, I think this one have to do with the technology kind of like the bubble burst, kind of like mini bubble burst. So you can also see that right now we are experiencing some sort of like a minor or small correction at the moment. But yeah, we shall see whether this correction would happen again. So yeah, I just want to remind you guys that, do you guys remember the Japanese carry yen trade?
Yeah, feels like a long time ago.
Yeah, I remember very clearly because that happened during my birthday.
Oh.
So next day, 5th of August, market open, straight away dump. All of a sudden, like 10% drop in just a span of like few minutes actually. It's because it's just when you open the market open, it crash. So usually investors are not prepared for this kind of like thing because crashes come unexpectedly. It won't tell you like, hey, tomorrow you're gonna crash, so be prepared, So yeah, it's always like unpredictable. And here is what we think that you should do and don't during a market crash, or how do you actually prepare for one. And before we share, this is basically like you are running around the cliff blindfolded because you don't know where the market is going. So you don't know when the end of the cliff will happen because you are blindfolded. So number one, things to avoid, this is specifically for companies that you are investing in. So you want to avoid companies that have a lot of debt.
And I think before that, I think it's worth repeating yet again that it's about creating a grocery list of companies that we want to tap into when the market eventually crashes, right? So the question is what kind of companies will fit into that grocery list. And I think on the top is net debt. Now, I think big reason why is because during a crash, usually there's a reason why it crashed, and it's usually recession related or systems related, meaning there's a systemic issue like banking crisis or whatever. And when things like that happen, if the company is in a lot of debt, there's a good chance they will suffer because they might lose some business. And if the debt is very big, then
they cannot repay.
Yeah, they can't repay the interest, or suddenly the banks will lend them the money, increase how strict they are, or worse is if they rely on debt to finance some of their operations. Then now they can't take it, so the operations halt, and then it spirals into something bad.
Yeah, this is especially bad for those that actually take out a lot of short-term debt, Because
There
short
you go,
term,
yeah.
you need to turn over like within 1 year. So if that 1 year your business is bad, right? I think
That's right, that's right, yeah.
that's where you get.
So the second one is inconsistent cash flow. This one can be not as bad as net debt because, of course, we want consistent cash flow, especially in times of recession, because cash flow is king. But you can be a bit less strict on this if the company is not in a net debt position. So if the company is net cash, they can actually use the cash to survive a little longer and not rely on cash flows.
Yeah. But the funny thing is that a lot of companies that are in a not inconsistent cash flow, they tend to be net debt.
There you go.
And because they need to use short-term funds to actually finance their working capital for the inconsistency.
There you go.
So yeah, obviously, I mean, if you think about it, you want a company that always be making cash flow, consistent cash flow on a yearly basis. If it's inconsistent, it's pretty hard to predict where the company's outlook will be because because of their nature of business, and it's difficult to predict what they will do in the future. Now, the third one, this one is probably a little bit controversial. High earnings growth. High earnings growth also have to do with meaning to say their cost of capital is low, access to cost of capital is low. That's why they can actually perform well during those times. So if let's say a crash happened, right, most of the time, I would say like maybe even 99% of the time, companies will not be reporting all-time high earnings because a recession is here, which means business is bad. So which means the high earnings growth that they have been producing in the past may not be replicatable in the future or during that time. So what does that mean is that, and also just to share, high earnings growth also tend to have like a higher beta. So higher beta meaning the fluctuation in share price is much more wider as compared to those that is have a lower beta. So if let's say they suddenly reported bad earnings, so for example like Nvidia, right? So right now the price is going up because they have been reporting good earnings. But what if they reported bad?
Or they miss targets.
Or they miss target. So how would the market react to that? I'm pretty sure that they will be quite disappointed because they think that Nvidia is like the new blue chip that's supposed to grow their earnings every single year. So yeah, this one, it is a controversial one, but I think it's still very important for you to take note. Now, on the flip side, what you need to have before even a market crash is actually, number one, very simple one, is the cash. But cash, this one depends on every single investor. It depends on how likely do you think a crash will happen and how much do you want to be prepared for it. So everybody have a different amount of percentage of cash in their portfolio. If you think that the companies that you invested in are good, obviously you want to be 99% invested instead of holding cash, right? But if you are uncertain of the outlook, or you just simply cannot find any good ideas, right, then I think it makes sense for your cash to actually be a much more significant in terms of your portfolio size. And right now, Mumu, they have this Cash Plus program where you can earn up to 5% per year. So last time it was 3.5. Yeah, now they bump it up to 5%. So what does that signal you? I think it kind of signals you that probably there's a market correction coming in. If let's say like something like a money market fund or even fixed deposits, interest rate is increasing, right? So the better alternative is actually just putting inside cash. And you also can get a 40 ringgit free cash voucher if you use our code FIRE24. So make sure to check out. The links will be in the description and comments below.
Too busy to find stock ideas? Check out Fire Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description.
So cash, the second one, MJ just now mentioned about grocery list, right? So yes, you need to have a watch list so that you are prepared to go into the market and you know what companies to buy already. And we already have like a watch list. This one, it is the Flash Ideas watch list. Only for the Fire Pro members. So if you want to join Fire Pro, the links will be in the description and comments.
It's Flash because it's fast, right?
Yes.
It's just
fast. And also this is also one of them is one of my personal watch lists. So if you want to know what am I looking at, it's a watch list for a reason, and it's just I'm putting there to monitor to make sure when the price is right, I'll be the first to actually enter it.
Grocery list.
Yeah, the grocery list. It's very important for you to have one so that you know what you are investing during market correction. Now, third one, this one not many people talk about, which is active income.
Oh yeah. Oh,
yeah, I think this one is a very underrated kind of like preparation that you need during a market recession. If let's say, during a market recession, will you still have your job? Because some recession, right, like your COVID market crash, some of them actually most of the tech guys actually lost their jobs. Because things can actually be done remotely and no need to be there, or maybe they just thought that they overhired. So you need to ensure that your active income, it is still there. Remember the inconsistent in cash flow. So that is for companies. Your personal one also need to be you also need to have like a consistent cash flow. So if you cannot like build your own cash flow, you won't be able to invest in companies or even pay your own personal expenses. So make sure that your active income is still there. And better yet, if you can actually increase your active income by doing like those kind of like side hustles, so that you can actually take advantage during these market crashes. So yeah, this one is a very underrated one.
Yeah, but of course, this is true for working adults, all right? I think if you are already retired, then I think the part about the first two is more important.
Yeah. Yes.
Cash, thinking how much cash you own, and also a watch list.
Yes. Okay, so some of you guys may be thinking about, hey, what about shorting put options or leverage, right? Because during times are bad, you want to be greedy, right? But I would say these three kind of like investment strategies requires a lot of timing the market. So timing usually it means that you need to predict like certain time periods where you need to buy and you need to sell right away. Because for example, like shorting, what if the crash only like it rebounded like the next day after it crashes, right? And you are not prepared for it. What that means, you will be losing money, because shorting, you are betting against the market. Same thing for put options. Same thing also for leverage, because what if you don't have the money to actually pay the interest, or let's say the company that you buy dip further. So this one, it requires a lot of risk, and we usually don't recommend you to actually implement these three strategies unless you are very sophisticated and you have very deep pockets, that you are only like, let's say, investing like maybe 10% of your wealth only, and you have the capability to be prepared for the worst to happen. So yeah, ideally, if you are those type of profile, then you can adopt this. But I would say like most of you guys who's watching this video are not. So it's best for you to just ignore these three investment strategies. Okay, so that's about it. And the unpopular few things that you may want to know is that, number one, during a market correction, obviously your portfolio will not be green, you'll be red. And we think that you should not be cutting loss unless the company that you hold are the one that we mentioned in the avoid part segment, which is their net debt, inconsistent cash flow, bad capital allocation, bad management, bad business prospect, all those kind of things. So yeah, if let's say they are a good company, we would recommend you to actually, not recommend, we would want you to think twice before you actually cut loss. Because usually good management, good businesses would rebound back at the end of the cycle of the crash. So yeah, DCA when you have the money lah. Now two, you don't want to look at your trading screen every day. I'm pretty sure that most of you guys will be looking at it when the market crash, because you are worried whether the crash will be even the dip goes deeper lah. So to prevent you from being too emotional, it's best to not look. Just don't look at your trading screen every single day, and maybe just look at once a month when you have income coming in, means your salary come in. That is the time where you can actually look and think whether you want to buy or just park in cash. So yeah, this is very, very important to control your emotion. Number three is you want to make more money or do more research. So make more money is just like find a side hustle that can boost your income, because this is a time where you an opportunity.
Cash is the best, yeah. At this point in time.
Correct. Cash is the best, and you want to find more money to actually deploy to the market so that you can buy it at a cheap price. And research, obviously, you want to two times or 10x your research time, because that time is the best time to actually hunt for good ideas. Okay, fourth one, gold, unit trust, and EPF. I have my own personal view. Later, maybe you can share yours. So I think that you should not be investing in gold, unit trust, or EPF, because during a market correction, that is usually the time where stocks are at its irrational price point. Which means you wouldn't be able to get that particular price point during a bearish market or even a bullish market. Because a crash is a crash. Like, irregardless if they are performing or not, it will still drop. So I think that is actually the best time to hunt for good ideas in the stock market instead of parking money into gold, safe haven assets during that time, like gold, unit trust, or EPF. Because EPF, right, it's very long. It's like 55 years. Unless you have 1 million ringgit in EPF, then that's probably a different story. But for gold, it's safe, but then your returns will be just very minimal.
You actually have to invest. If you want to take advantage of gold, you actually have to invest it ironically before a crash, not during. Because if you look at how gold price have moved, right, they've actually been the same or maybe even a bit more than the S&P 500 in terms of growth. It happened during good times, right? So it's a bit false when people say gold is some sort of protection. So like you say, when it drops, actually you want to switch. If you have gold, you want to switch into stocks. Now the only thing here I would say is for unit trust, because 90%. Do you remember the stats that we shared in our video? Maybe we can put the link here somewhere.
The unit trust,
roughly
86%,
almost 90% do not outperform the market.
ETF.
I think before fees, if I'm not mistaken. So if we include fees, even less, right? 90%. However, some of y'all might be hardworking enough or fortunate enough or so happen you know certain unit trust managers who are actually proven. That is actually ironically the best time to give them the money to invest for you, even though you are paying your fees, because these are proven fund managers, and there are proven unit trust fund managers out there. You just have to know which one, and perhaps you are already investing in one that has grown your money really, really well, and don't give up on that fund manager, because I know some of y'all don't actually want to invest in your own stocks. Like, you don't want to do the work on finding out what is the the no list, the do's and don'ts for creating the grocery list of companies, right? So yeah, but EPF, I also agree. It's the thing about EPF is that there's no price for you to take advantage of. So you put it in, it's probably going to be worse for you for the next year, because the dividend is probably going to drop for EPF during a crash, right? So yeah, EPF definitely out of the question. Just continue contributing it as an employee. But I think, those are the two things I'll add up for gold and unit trust.
And the last one, more emergency fund, because you never know whether you lose your job or not. So I think it is the best time for you to...
Because it really depends on what job you have as well, right? Are you affected? Are you not affected? Regardless, you should... I think by the time a crash comes, you should already have an emergency fund, right? Or if you're just starting out, it kind of sucks actually if you're just starting out, because during a crash, you probably have no money. So you just... that one's just too bad. It's just bad timing.
This one is just for the unexpected only. It's just for you to better safeguard yourself.
Now, of course, if you don't know... If you find it too difficult to find the groceries of ideas, that's where Fire Pro come in. It's a program that we've been running for more than 2 years now. In that same time, it's up almost 45%. By November, it'll be about 45%. You can see what are our grocery lists, right, in 3 different ways. The first is FPM. This is the Malaysia portfolio. FPG, this is the global portfolio. And then there's the boring portfolio, which is more for dividend and more safe kind of companies, even though it has done, I think, pretty well this year. Then to know further about what is inside the portfolio, we do have write-ups on these companies, right, that take you no more than 15 minutes to read. So it's very, very short and sweet. You know all the important points, and you don't need to know all the other jargons and fluffs and all that. Help you reduce your research time by 90%. So we have minimum 2 of these sort of write-ups every month. If you want to get a taste of what these write-ups are, you can check out the free sample in the comment section or description. And with that, I'll see you in the next video. Bye-bye.